Thanks for joining me today at Get Connected at QuickBooks. So today we have a really interesting topic for you, something that business owners are very interested in right now, but also yourself as an accountant, this should be something that you're very interested in, both for your business, but also for your clients' businesses. And I'm going to talk why it matters that your clients' businesses have strong cash flow. So let's jump into this here. So what's this session about? So the session, I've titled it Navigating Clients Through Cash Flow Uncertainty. So, there's a little preamble here, but cash flow is important for periods of downturn, but all periods of time cash flow is critically important. But I think now people are more conscious about this and more aware given the environment that we're in. So as a trusted advisor, the expectations your clients have is that you're going to help them navigate through these times. By providing guidance to them, you're differentiating from other accountants or bookkeepers that are not thinking this way. But in addition to that, if your clients get through this difficult time, at the end of it, they're going to remember you because you're the one that helped them navigate the situation and come out on the other side of success. So it's building long-term loyalty from your clients, showing them why you're valuable as an advisor. And ultimately, where we're moving towards as accountants is not necessarily just being someone who can do compliance work. The future, in my opinion, is an advisory. Anybody can do your taxes, but you want someone that digs in and shows your client how the business should be run, ways they can make it more efficient, how they can leverage technology. So ultimately, that's what we're aiming for here through this session. We're going to give you some tips and tricks on ways you can look at cash flow management with your clients, but in addition to that, I'm hoping throughout the presentation I show you that being an advisor to your clients is what's going to help differentiate you and help you grow your business. So who am I? My name is Andrew Zachariah. I'm a chartered accountant, CPA, CA. I started my career with PricewaterhouseCoopers in Toronto, and then I actually did a secondment to London, England with PricewaterhouseCoopers. In addition to that, once I came back from England, I worked in finance and audit roles at a variety of different companies across Canada. And from there, in 2014, I started my own firm. So I've had my own firm now for 6 years. My firm is based in downtown Toronto, but that we actually operate remotely across the country. So we have clients all over Canada. And my firm right now is pretty much a hybrid between a remote firm fully for my staffing as well as people working at the office. So at my office, I have 3 staff that come in full time and they sit at the office. And then I have 6 other staff that work remotely. And they work from home and they always have worked from home. So during this time, maybe some firms had to make a transition because they no longer have clients coming into the office or their staff can't come in. For us, it wasn't a big transition. One thing I do want to point out is this session here is eligible for CPD credits. So in addition to the learning you're going to get, you're also going to get some time that you can put towards your CPD requirements. So what's the agenda for today? So the agenda is going to basically do an impact of COVID-19, what the impact has looked like for businesses. I'm going to talk about that a bit with some facts and then some personal experiences. In addition to that, I'm going to go through some best practices for cash flow management. These are things that you can implement in your business, and then there are things you also can recommend to your clients as well. I'm going to talk about some techniques that you can use to help your clients evaluate what should they do to manage their cash flow. So there's a lot of different options out there, from financing to software tools. A lot of people are using spreadsheets. Clients don't even know where to begin. So I'm going to help you figure out how to navigate your clients with the various solutions that are available to them. I'm also going to talk about different QuickBooks reports that you can use to help make decisions around cash flow. So ultimately, making decisions around cash flow, you want to set it up in a way that ultimately the client will be able to look at these things on their own and not 100% of the time rely on you. Also, by showing the clients the benefit of using tools and reporting, they're going to see more of the benefits of you doing the bookkeeping. One thing I have with my staff, and if you have staff yourself, you probably have experienced this. My staff will do a great job on the bookkeeping, which is the back end. But if the client, let's say, will email them a question, and if they take 2 or 3 days to respond to the client's coming to me and saying, your staff are not responsive. The client is generally noticing only the interaction you have with them and not noticing the software and all the good work that you're doing in the background with that software. So if you're able to integrate QuickBooks into your practice and into your clients' day-to-day, then they're going to see all the benefits and hard work you're doing behind the scenes, which 80-90% of the work that you're doing for them might be the actual bookkeeping, and 10 or 20% might be the interaction you have. But if you're doing a great job on that 80-90%, but a poor job on the 10 or 20% of interaction, that client is going to think you're not doing a good job. And you can tell them, well, I spent 10 hours on your bookkeeping this month. They're not looking at it like that because they don't utilize QuickBooks maybe themselves or the systems themselves. So this is not only going to help with their cash flow using QuickBooks Report, but if you get them involved, they're going to start to see what work you're doing behind the scenes and then start to blend that 10-20% with the 80-90%. Some tips on how to have these discussions with your clients, because ultimately, number one, you want to approach this in a sensitive way. It's a financial thing that a lot of people are experiencing hardship, so you want to make sure that you approach it the right way. There's also opportunities here to increase your service offering to your clients. And you don't want to approach this from a sales perspective or from a perspective that you're trying to take advantage of a situation and take more money from them. Ultimately, what you're trying to do is help their business grow and do better. So we're going to talk about how to approach your clients with cash flow management. Then we're going to have, at the end, a time period left set aside for questions that you have on the presentation or anything related to this. So moving on, what is COVID-19? How has this impacted your small business clients? We're going to jump into some statistics. So 46% of small businesses have partially closed. And I'm sure everyone's aware of this by now, but especially businesses that are restaurants or don't have the ability to allow for social distancing, they've all been impacted by COVID-19, both directly and indirectly. 31% of small businesses have entirely closed. So again, you have businesses that are restaurants that maybe partially closed means that they are still doing delivery or takeout. But some have completely closed, meaning not one employee, nobody's there. All they have is the bills to pay, but no revenue coming in whatsoever. If we look at the individual level, 44% of households have actually completely either lost their job or reduced their hours at work. Now, why does that impact small businesses? Well, small businesses, the money that they get is being fed by the consumer. So a lot of people today are trying to figure out, well, when is the economy going to return to normal? And, vaccine is something that's being pointed out as a solution. But the overarching thing is, as long as consumers are not outside and not spending money, everything else is going to be impacted. Because if consumers are not spending money, it means businesses are not getting money. If businesses are not getting money, people are not able to be hired to work at those businesses because there's no demand. If people don't have jobs, they're not spending money. It almost seems like a vicious circle. The one thing to keep in mind that's unique about this whole pandemic versus other issues that we've had in the economy is it's just actually a certain segment of the population that's been affected by this. It's not the entire economy or all people have lost jobs. A lot of people still have their full incomes. But even those people that still have not lost their jobs and have money, their decisions to spend money have been affected as well. So they're more conservative with their buying or purchasing decisions because they're thinking, well, I don't know exactly what's going to happen in the next 2, 3, 4, 6 months. So maybe I should set aside this extra money I'm making. I used to spend $500 a month on restaurants. Now I'm making food at home, so I'm saving $400 a month. They're putting aside this money and saving it because of the uncertainty that exists today in the environment that we're in. Now, a lot of places have already started to open. It depends what province you're in, but I'm in Ontario. So Ontario, we're in stage 1 where we're reopening certain types of businesses. But there's 3 stages to this, and it will be, probably over the summertime, if things permit, we'll continue to open. But even when things do open, businesses are not necessarily going to get to the same level they were at, potentially for years, but definitely not probably a best case scenario to end of 2020 or sometime in 2021. So cash flow is really going to be something you have to monitor because you cannot forecast things based on the history that you have because the history you have didn't include COVID-19. People that had plans or made plans or we're going to have vacation travel plans, or if you're a business, you made a decision to make an investment for a renovation, or if you're a buyer for a company, so your job is to buy product, you would have put those plans on hold and extended your time maybe out to the future before you made those decisions and concrete those decisions, because you're unsure what's going to happen in the future. So just something to keep in mind when you're working through the cash flow with your clients. Cash flow management. So we're going to talk about at a high level and then jump into the details here. What are the benefits of implementing a cash flow management system? And what are the outcomes if you choose not to implement a process? So the way I approach my clients is, when I take on a new client, I go through a questionnaire with them to understand the way that they're doing their business. And the reason I do this is, again, I'm approaching this as an advisor. The client knows what questions they have, but they don't know what questions they should be asking you in 100% of scenarios. So a lot of times when you talk to someone who's an expert in something, they'll answer all your questions, but one of the questions I usually have to an expert that's not an area that I'm comfortable with, I say to them, is there any questions that I should have asked you, but I didn't? And the reason I do that is because you don't know what you don't know. So it's the same thing with your clients. They are running the business based on their history, their life, their learnings, their experience, and their strengths. And many business owners, their strength is not finance. And even if they do have financial acumen, they shouldn't be spending their time managing the finances of the business. They should be running the business and simply reviewing reports, relying on a financial expert that they've engaged, which is you, to help them manage the finance, and as well also guide them and help them figure out the ways to get over hurdles and take their business to the next level. So why do you want to what are the benefits of implementing a process for cash flow management? Well, if you want to be able to forecast out when you're going to have a positive cash flow, when your business is not resulting in a positive cash flow, if you want to grow a business into a profitable one, if you want to foresee and be proactive in shortfalls that you're going to encounter, if you want to prepare yourself for slow periods, whether they're expected, maybe you're in a seasonal business, so you know that you only actually make money 6 months of the year, and 6 months of the year you operate at a loss, or you want to be prepared for periods that are unexpected like COVID-19, the cash flow is going to allow you the flexibility and the insight to see all that well in advance. So for my clients, it depends on the business, but generally we recommend at least a 2-month cash flow, and we do a rolling cash flow for them, which means this week we would update the cash flow, and that would show 2 months from now where they will be. The opening point on my cash flow, my starting point, is what's my current bank balance. Then I have a section that shows what are all the ins I'm expecting that week. And then I have another separate section that shows what are all of the outs I have this week, all the expenses. And then what that's going to bring me to is that's going to bring me to the net cash flow position expected at the end of that week. Then that ending position will be my opening position for the next week. And then I would carry on the same formula. What are my ins and what are my outs? And the longer you forecast out, the less accurate this becomes. So that's why I don't forecast out 2 years, but maybe during your budgeting and forecasting part for your annual budgeting forecasting process, you would also do an annual cash flow, but you'd want to, maintain that maybe on a monthly basis and then do a 2-month cash flow on a weekly basis. And the revenue, the ins, are going to be things like your recurring revenue. Maybe you have subscriptions, maybe you have daily deposits, and those you can use historical or averages to determine what those are going to be. You know this week's, but you're not going to know next week's or the week after. But the other types would be AR, accounts receivable, and these will be based on the payment terms that you have with your clients. And we'll talk a bit more about this later. But those are the ones where if you don't really watch your AR and manage it properly, your cash flow is going to be greatly impacted. So let's say you decide, you know what, I don't need to do cash flow management. I think I'm fine. I have money. What are the potential downsides of this? Well, if you run into a negative cash flow situation, you probably would have not foreseen that or foreseen it as early as you would have had you been doing a cash flow. As a result of that, you will potentially not be able to grow your business. Your business might fail. It's always easier to get money and help when you have time and when you're in a position where you're not tight. When you're tight on money, you'll make poor decisions, or the people that are going to give you financing or help you at better preferred rates are not going to be open to it because you're such in a tight spot. And the other problem is if you're a product business and you're relying on your cash flow to fund your accounts receivable, and it's basically a circle, meaning you want to make sales to your clients, they have long payment terms, you use the accounts receivable money that comes in, and then you take that money and you buy more inventory, which you then sell, that working capital, that whole cycle is going to be disrupted unless you have good AR or financing, which we'll talk more about. So these are kind of a high level benefits and outcomes if you don't have a cash flow. So we're going to talk a bit more about benefits. So number one, out of sight, out of mind. As an accountant, you're thinking about accounts receivable, accounts payable, expenses, income. That's top of mind for you. And you probably have a mental block thinking, well, doesn't everybody think like that? Don't you want to know if you're collecting your money? But believe it or not, a lot of business owners are very, very focused on the day-to-day operations of their business, especially early on in the business. Maybe 3, 4, 5, 10 years into the business, they step back. But a lot of clients start a business, and let's say you start a restaurant business for 1 or 2 years, you're working 7 days a week. All you're trying to do is keep that business running. You're trying to keep it afloat. You're trying to motivate and find the right staff. You're trying to deal with all the learnings that come as a business owner, the HR aspect, employee problems, dealing with financial issues like this, but any other financial, just managing money. In addition to that, keeping your clients happy, finding better suppliers. There's a million different things you have to worry about. So you would think that money and collecting money is top of mind, but if you're a business where 80% of your revenue comes from one source and 20% is another, so let's take a restaurant. Maybe most of your money comes from sit-down clients, but then you have Uber Eats or Fedora or other types of delivery services. You operate your own delivery service, and in addition to that, you do catering. You might have most of your focus and time and energy on the in-dining experience because that's where most of your revenue comes from. And you might forget about the fact that you did a big catering order a month ago and they still haven't paid you. So if you have a cash flow, and that cash flow, back what I mentioned in the previous slide, you're forecasting out 2 months, and your ins and outs are going to be all outlined there for you, and your ins are going to include your expected accounts receivable. When that cash flow is reviewed, and if you review it with your client, let's say once every 2 weeks, maybe you prepare it weekly but have a bi-weekly call, you're going to say to them, just so you know, in 2 weeks, we're expecting to collect this money from XYZ company. If we don't collect that money, you can delete that line there, and that will show them your business is actually going to be in a negative cash flow position. So out of sight, out of mind. If they don't see and are reminded constantly of the fact that they have money that they need to collect, they may not actually collect that money either at all or on a timely basis. And the longer that someone's waiting to collect their money, the longer the client knows, or their client knows, well, this person's not asking me, I'm just going to pay the people that are asking me, the higher the risk of not collecting that money from your clients. The other thing cash flow management's going to do, putting aside the revenue or the receivables or income side, it's going to actually help you manage what you're spending. So some people are great at budgeting and figuring out how they're going to spend their money, but others are not. Many people are not. And again, if people are seeing when they're looking at a cash flow and they see at the bottom of the cash flow, this is where I'm spending my money, That is a conscious decision as to continuing to reallocate that money to that area. A lot of people have their money, their bills come out of their credit card automatically. And because it's automatic, they don't actually realize where the money's going. This cash flow is going to show, here's where you're spending money every month. During COVID-19, it's a tremendous amount of clients I know revisited their expenses and realized they had tons of expenses, that subscriptions, for example, that they have that they don't even use. Well, I've been paying $50 a month for this. I haven't used this for I can't remember when I've used it. The thing is, people tend to focus on the low-hanging fruit and the big wins, but these little things in aggregate actually can be substantial to a business. So again, if the client's looking every week at where their money's going and they see it on a cash flow, they're going to say, why am I spending this money here? Every time they look, they're reevaluating, is this a good use of my resources? And again, monitoring cash flow regularly, you're teaching the client to think in terms of cash flow. The more they see it, the more they're going to think in that way, and the more value that they're going to see from the relationship that they have with you. You're teaching them the importance of monitoring cash flow. I have clients that I review cash flow with them bi-weekly on a call. They will come to me and say, we have this change happening in our business, and this will be perhaps in between a call. We're in a week from now, we have our call, but I wanted to tell you this change is coming up. So can you update the cash flow? I just want to have a quick peek at it and see how that's going to impact it. Number one, you are now a partner in the business when a client makes that decision. They say, this person is important to me. I want to let them know what's going on. The second thing that's doing is actually, the client views you as a partner and they're involved in the process now, and they're inherently saying, I see the value of having this reporting and information available to me. So when a client asks you to make that update, it's because they want to go and have a look. They're validating that why this cash flow is needed and ultimately why you're necessary to their business. So when they're looking at ways to cut costs, they're not going to cut cost of an integral part of their business. You're going to be like their rent or their telephone. You don't want to be that subscription to back-end bookkeeping that they've had for 2 years, and the only time they talk to you is once a year at tax season, because it's really easy to cut something off that you have no emotional tie to or no tangible benefit you're getting from it that you can identify. And being a back-end bookkeeper without any kind of advisory value add is going to put you in that place. Okay, so now we're going to talk about collecting money from your clients. So why is collection such an important thing for all your clients? Well, first thing, by staying on top of your invoices, you're ensuring that you're going to collect money from your clients. Your cash flow is going to be consistent. You're also sending the right message to your clients saying, this particular person that I deal with finds being paid important. And who you pay many times comes down to who asks you for payment. A lot of people, it's not that they intentionally don't want to pay you, but they're busy and preoccupied in their day-to-day, and they need reminders. Another thing you can do is you can make payment convenient and easy for people. Don't make it difficult for a client to pay you the money that they owe you in order to save a 2% fee. Now, again, it depends on the kind of business you have, what's customary. A lot of professional service businesses like ours or lawyers, they actually don't even accept anything but cash or e-transfers or check or wire transfer. But if your business is customarily accepting credit cards as payment, why should you be the exception to that? And it's better to get 98% of the money that you're owed from a client today than 100% 5 months from now after getting your lawyer to write a letter for you. And if you're in your business, it makes sense, consider offering incentives to be paid on time or early. So I'll give you an example. If you had 2 bills in front of you to pay, one's $1,000 and one's $1,000, but if you pay it today, it's actually only $950. And these are equally important suppliers to you. Who are you going to pay? You're going to pay the one that incentivizes you to pay early. So that's something your clients might want to consider offering and something you could recommend to them. But keep in mind, if you offer this, you should build this into your budgeting, your margins, because you're actually losing money when you offer these discounts. But having that extra cash flow will mean that you actually have that money quicker, which means you might not have to leverage loans or other borrowings to fund your business. Another thing you can recommend to your clients as an advisor is get financing set up when you don't necessarily need it, or getting financing set up before it's too late. So all businesses probably would benefit from a working capital operating line or a line of credit. That is only something that generally has a fee or a cost when it's being used. And if it's not used, then there wouldn't be a cost to it. So there's really no downside for the client to have that. And it's going to help them during periods of cash flow uncertainty. When you start a business, you're really not in a position to bargain with your clients in many cases and choose your clients. So when you start out, you're just going to be happy to have any client that comes knocking on the door. As your business grows, you could be more selective, but at the beginning, you're pretty much going to take anybody on, even if that means taking on someone that you're hoping they pay you and you think they will, but maybe you might have to push them. But if you're lucky to land a very big account, so I have some clients that deal with Walmart, Shoppers Drug Mart. The problem you have with those relationships, they're great in the sense that your name's getting out there, their sales volume's high, their order volumes will be predictable. However, they dictate the relationship and dictate the payment terms of the relationship. So if Walmart is buying from you and they say we're paying you in 90 days after we receive the goods, you're not getting paid early. You're getting paid on 90 days. What that means is you're going to have to be able to come up with a way to fund your production so that you can give it to Walmart and then wait 90 days. There are lenders out there that do what's called invoice factoring. And invoice factoring basically says, I'll give you 90% of the invoice value because I know Walmart's going to pay their bill. So I'll give you 90% right now and I'll wait for Walmart to pay and then I'll get the 10%. And they'll do that. And yes, that eats your profit. But at the onset of maybe that's the only way for you to actually say yes to Walmart because you think, well, I have no way to take on this relationship. And your client might come to you and say, hey, I have this offer from Walmart to do work, but I know realistically I can't fund the inventory. So what do I do? And you tell them, well, you know what? Take the client, even if you don't make a lot of money at the beginning, we'll use factoring. Once you have that relationship, we'll see what we can do. We can find other lenders because just establish a relationship with Walmart and then we'll figure out the best way to move forward. So on managing payables side, COVID-19, as I mentioned, it really caused a lot of people to examine their spending, but you should not wait for a downturn to be reevaluating how you're allocating your resources on a regular basis. What made sense for your business today to spend money on might not make sense next week. If your business is changing, your needs change, and you got to look at every single expense from the ground up. So you've heard of zero-based budgeting where people every year, instead of saying last year you spent $50,000, what do you need this year? The way you would approach it is you have $0 to spend, justify every dollar of how you're spending in your business. Redoing that exercise on a regular basis is actually a good thing. So you need to say, what can I cut from my business in terms of expenses and what can I cut? What is absolutely necessary versus, it's a nice to have. And then in my expenses, okay, I'm a food business, I need food supply. But then you're going to ask yourself, well, I'm currently dealing with these two suppliers and maybe there's other suppliers out there that I can go to and negotiate with, especially in a difficult time like this, and get better pricing. So you do want to take advantage of the current climate that we're in to see if there's opportunities to further improve or reduce your expenses. Can you go after you've been with your client, your suppliers for a long time, saying, I typically pay you cash on delivery or 30 days after delivery? Can I now extend that to 45 days or 60 days? Now, you might be thinking, well, I already have to pay the money. I might as well just pay it as soon as I can. But if you can extend your payment terms by 30 days, it means you have 30 extra days to pay your bills. it means actually you're borrowing or you have free money you've borrowed for an extra 30 days. It's interest-free debt. Or if you want, put the money in your savings account, earn some interest on it, and then pay the person on day 60 now that you've extended payment terms. So extending your payment terms is a way to increase or improve your cash flow. Take advantage of every single government or lender program that exists, even if you don't need it, as long as you're eligible. And this is something you should be doing. So with my clients, I actually took a list of all my clients, the industries they're in, I categorized them by industry, and then from there I said, looked at who needs wage subsidies, who could benefit from them, who's eligible for them, same thing with government loans. These are the kind of things you need to be doing for your clients proactively and bringing it to them and saying, hey, by the way, I know you have $2 million in a bank, but there is a program right now out there that's going to get you $10,000 for free. The client is never going to say, well, I don't want the free $10,000. They're going to say, thank you so much. You actually just paid for your whole service fee for the whole year just by that one, recommendation. The other thing too is in payables, you have to ask yourself, how am I going to maintain my current level of sales if I cannot fund my bills? So it's similar to the Walmart thing we said. If you are not able to pay your bills, then you might not be able to actually produce the products that you need to make your sales. And it's almost like a vicious circle, and this is where alternative lending or working capital lines would come in. Monitoring cash flow regularly. So I recommended that you do it on a regular basis, ideally weekly. For my accounting firm, I have a cash flow out from now to end of September. Again, it's not perfect. I update it every single week, but I actually know right now, as of September, I know how much money I'm expecting in the bank, which is, again, difficult for most people to do, especially at this time. And it's not foolproof for me, but as accountants, bookkeepers, our businesses have fortunately been less affected by this whole situation. Now, you can do all this manually using a spreadsheet, but why not use the tools that exist in QuickBooks? You're already doing the bookkeeping. Why not leverage the tools and leverage the system to do this work for you? So I'm just going to quickly talk about 4 reports that you can use in QuickBooks that help you monitor cash flow or make cash flow decisions. So the first one is a statement of cash flow. So this here is going to really divide up how you've spent your money into a few different buckets. It's going to say, let's say last month, this is your amount of money that you brought in, which in this case, in this example, is a negative amount. Where did that money that came in and out, where did it go? And it really divides it into operating activities, financing activities, and ultimately, if you look here, you'll see these are the areas where you put your money towards operating uses. And then here's the areas that show you towards financing uses. So it's just this is more probably an accountant type report to review versus the client. They might find this a little confusing unless there's someone who has a good financial acumen. But it's just a really interesting, quick way to see where am I deploying most of my money. A business that's very debt heavy and not investing in growth or day to day is going to be very heavy in the financing side. And that might indicate maybe I need to look at my financing, the way I'm getting it, or the rates, or the programs I have, and see if I can reorganize it. If you're very heavily investing in operating and you hardly have anything in the financing, you might say, well, that's great, I had no debt. But maybe if you borrowed some money, you'd be able to do things to improve your business, grow your business, or find ways with that money to better leverage your operating expenses. Maybe you can, for example, there's certain, you can buy in bulk. So maybe you're an inventory business, heavy business, you spend $100,000 a year in inventory, but you only spend that money over the course of the year. Maybe there's a big supplier that says, if your minimum order quantity is $25,000 each time, I'll deal with you. Anything less than that, I won't deal with you. So instead of having to buy from 10 little suppliers, maybe you borrow money, which will show on the financing side here now, and you use that money to buy inventory at a lower price. So even though the financing has a cost to you, the cost actually might outweigh the benefit, might benefit you more and outweigh the fact that you're spending more money. AR aging summary. So you ideally don't want to have anything that is not considered current. The current is going to be things that have, good or up to date. You're expecting that they haven't paid you yet. The further along you go in the days, the further out it means the client has decided not to pay you from the time you issued the invoice and expected payment. You don't want anything that is really old, because that means that person is not paying you, and it means the risk of you collecting that money is continuing to increase the older this thing gets. My staff, this is a bookkeeping thing I want to mention to you. So where I pulled this reports from is QuickBooks has a sample company called Long for Success. So I pulled these reports from there. My staff, we have a month-end process, and they have a self-review checklist that they have to do before they provide the clients a review for me. One thing I always tell them is anytime you have a negative receivable, make sure you investigate and figure out why. Nothing's worse than giving a client an AR report and then they ask you, why is there negative receivables? So one thing I'll add is these reports here, if you're going to share them with the client or you're going to tell the client, you can go in and run these reports when you want to, make sure you're keeping them up to date or setting expectations saying AR report will be updated every Wednesday. You don't want them going in running the AR report and it's a mess. Collections report. So this is just showing you pretty much who's overdue at the detailed invoice level. And terms list, this is showing you your various payment terms that you have set up for clients that you can select from. So this is where you can customize, build in discounts. So you can tell someone if they pay by this date, they get a discount. You can build all this stuff into QuickBooks so the client, once you sit down with them and set these up, they don't have to worry about doing it with each of their clients independently. All this discussion should come with the client when you're setting them up and onboarding them. You have a list and you say, okay, we're going to talk about your clients, how you collect their money, your cash flow, your budgeting, your terms list. They're going to think, wow, these are things I didn't even think of, and there's so much tremendous value I'm getting from this relationship. Helm. So Helm is an app that you can use to actually help automate cash flow. I put a link in here. You can Google Helm app. Ultimately, what it does is it pulls all of the data from QuickBooks, all of the deposits, all of the AR, all of the AP, all the expenses historically, and use that to build a cash flow for you. So if you don't want to build a cash flow forecast future for your client going out to the future, this app will do that for you, and it integrates perfectly in QuickBooks. So it's something I'd recommend you look at for certain clients. So how do you talk to your clients about these things? Number one, it comes with a collaborative approach. The best time to do it ideally is when you take on the client. But now is a great opportunity to say to your client, I know we're working together for a year. Let's book 15 minutes and just talk about your business. Here's a questionnaire that you can create for them. Here's a questionnaire, Mr. Client, Mrs. Client, that I want you to fill in. And this questionnaire here is going to serve for a discussion and ultimately give it back to me by this date so I have time to review it. And by doing this, you're going to, number one, get your client thinking about things. Number two, it sets the stage for the meeting and also lets you prepare your talking points. And you can even ask the client to rank the solutions or rank their issues. You're going to have an issue section in your questionnaire saying, what are the 5 things that keep you up at night? What are you most worried about your business? What are we doing a good job at for you? What are we not doing a good job? Or where do you think we could help you more? Is this relationship what you expected? I know you think, if I don't ask the client these questions, they don't think about it, but trust me, people are thinking about the relationships they have with you. So, it's better to ask and find out how the client feels than find out when they've exited the relationship. And then what you do is you review the questionnaire with your clients, come up with a plan together, and you can tell them, these are the 10 things I recommend. These 5 we can help you with. We can help you in 2 ways. Number one, we can set everything up for you so that you managed it. Or if you want for a fee of X amount a month, we'll set them up and manage them. Many cases, the client's going to say, I'll pay the $500 a month extra and you manage all this for me because I see the value. And if the client does that, you now have increased your business and you're selling to the same client. But if the client doesn't and they want you to set it up, no problem, set it up for them. Because number one, you've added value, you showed your value as an advisor, you've helped their business. That's what you're there to do, is help their business. Number two, just because they're going to manage these things today, it doesn't mean that they won't want to pass these back to you at some point in time. And you let them know that. Hey, let's set them up for you now. You run them. And if you have a problem and you want us to take on one or all of them, just let me know and we'll talk about that. No problem. We can revisit it. And this is all a time investment that you're making. But, if you're an accountant that does taxes, tax season's almost done. So why not take the summer, 1 or 2 months? This doesn't have to happen all in one day. You can say over the next 3 months, I'm going to spend 15 minutes or 30 minutes with each client that I have that I'm doing bookkeeping for and do these questionnaires. And, it's only going to put your relationship ahead, and it's going to help potentially grow your business, help you be a good referral partner for them, them to send people to. Because people talk at nighttime, they'll say, well, my accountant's doing this or that. And their friends who are probably business owners are going to say, oh, my accountant's never asked me about that. So just differentiate yourself that way. So now we're on to the question and answer period.